Hi, my name is Rahul Shah and I welcome you once again to this YouTube video where my goal is to make investing accessible and profitable for the average investor. Now let us jump straight into today's session, and what I have for you today is a case study, a simple case study where you're supposed to evaluate the business quality of three groups of companies. I have divided 9 companies into three groups, and what you're seeing on your screen right now is group number one. It has three companies: company A, company B, and company C, and you have to evaluate the business quality of this group based on three parameters. And these three parameters are the earnings quality, the balance sheet strength of the company, and the return on equity or the capital efficiency of the business. Now, as you can see, as far as the earnings quality is concerned, all the three companies have recorded growth between FY7 and FY13, but the numbers in between are a bunch of random numbers. There is no clear discernible pattern uh, that uh, you can sort of make out amongst these numbers. There is no clear trend, and that's why the predictive power of the earnings of these companies, I think, is on the lower side. Therefore, although all the three companies have recorded a growth in earnings between FY7 and 13, and none of the companies have reported a loss in any of these years, the earnings quality of these businesses, I would say, is average at best. Moving on to the debt to equity ratio or the balance sheet strength of these group of companies. Now, one of the big reasons that companies fail is because they have high leverage or they have too much debt on the balance sheet, and therefore having low debt on the balance sheet is always a good sign. And all the three companies in this group, I think, passed this test with flying colors. uh, Between FY7 and 13, the average debt to equity ratio of all the three companies have been consistently below 1. In fact, it is significantly below 1. Debt to equity of 0.4 times or 0.3 times, I think, is a pretty good achievement. Moving on to the return on equity of these businesses. Now, businesses in India, I think they have an average weighted average cost of capital of around 12 to 15%. Therefore, if a company is consistently earning an ROE of more than 14-15%, I would say the ROE is of good quality. The return on equity of a company is of good quality if it's able to consistently earn returns on equity of more than 15%. And I think all the three companies again do quite well on this front. If you look at the earnings quality, the ROE of the companies A and C, it is significantly higher than 14-15%. For company B, it's on the lower side, but then there's an outlier minimum ROE of 4%, which is sort of distorting or harming the average. So if you sort of move that out, then again the ROEs of company B, it starts to look better. So from business quality point of view, I think Group One has the companies in Group One has decent business quality, or they have decent fundamentals. Now moving on to Group Two, uh, Company A, Company B, and Company C. As far as the earnings quality is concerned, uh, you can clearly make out that the earnings quality of all the companies in this group is better than the companies in the first group. There is a clear pattern. Earnings are inching up year after year, barring maybe a couple of blips. But if you look at the earnings on a year to year basis, I think all three of them are recording good earnings growth. Between FY7 and 13, Company A has been able to expand its earnings by almost 4 times, almost 7 times for Company B, and of course, around 3 times for Company C. So, earnings quality wise, this group is definitely better than Group 1. Average debt to equity ratio, again, all three of them significantly below 1, in fact, significantly below what companies in the Group 1 has achieved. So, There again, greater marks to this particular group. Average ROEs, well, again, much better than Group A, sorry, Group 1. All the three companies in this group have ROEs which are significantly higher than the average cost of capital of these companies, which I think is a very good achievement. Therefore, when it comes to the comparison between Group 1 and Group 2, I think Group 2 is a winner by a long shot, in terms of earnings quality, in terms of the balance sheet strength, in terms of ROE. It is definitely doing much better than the first group. Now let's move on to group number 3. Well, I don't think it makes for a very good reading. Uh, all the three companies in this particular group seem to be of poor quality as far as the earnings profile is concerned. In fact, company A and B have reported losses on a regular basis between FY7 and FY13. And although company C has not reported any loss, the earnings trend is clearly downwards. From a high of 17.3, the EPS has come down to just 3.3 in FY13. So earnings quality perspective, I think this is fundamentally the weakest group. Debt to equity ratio also higher than group 1 and 2. Again, the weakest when it comes to debt to equity ratio. Average ROE meaningless for company A and B, in the negative zone because of the losses that they have recorded. Slightly better ROEs, average ROEs for company C, but then for this company the downward earnings trend and the high debt to equity spoils the show. So from a business quality perspective, I think that when you rank the three groups, group 2 I think is the best, followed by group 1, and group 3 I think is the worst of the lot. It has the weakest fundamentals. Now this is an interesting chart. If the business quality of group 2 is much better than the business quality of the companies in group 1, why is it that group 1 has done much better in terms of stock market returns between between December 2013 and December 2016, the 3-year period between December 2013 and December 2016? Every rupees 100 invested in companies of the first group, has turned into more than rupees 500 at the end of December 2016, whereas the same rupees 100 invested in group 2 has been able to grow up to just 150 rupees. Group 3, of course, has been a wealth destroyer, and it is along expected lines. So why is this the case? Why is it that despite group 2 being much better in terms of business quality, it is group 1 that has managed to outperform group 2 by a significant margin? Well, I think the answer they lie in the next two charts. This chart, as you can see, while we have taken into account just the business quality of the groups, what also matters is the valuations these companies are trading at. As you could see at the start of the 3-year period, the companies in group 1 were significantly valued at a discount to companies in group 2. If you look at the PE ratios, I think companies in group 2 had significantly higher PE ratios than companies in group 1, 2 times, 3 times higher, in fact. I would even go to the extent of saying that investors were assuming that companies in group A would actually go bankrupt given the kind of low Ps that they were attracting. But this was definitely not the case. We took a look at the fundamentals of these companies and realized that while these may not be the best companies, but they are definitely not going to go bankrupt. And therefore, when the business cycle turned, when the sentiment became positive for stocks, it is group 1 that ended up giving huge returns to the shareholders, to the investors. These are again valuation from a price to book value perspective, and you can again see the huge difference in relative valuations between group 1 and group 2. Group 1 stocks having significantly lower valuations than group 2. Look at the discount to book values for group 1. Group 1 stocks trading at a 50-60% discount to book values. which I think is huge. And as compared to the high quality group 2, the difference is pretty evident. And I think this is the reason why Group 1 stocks ended up outperforming Group 2 stocks by a huge margin, although it was the stocks in Group 2 which had better quality in terms of the overall business. Now, if there is something that I have learned in my 15-year long career at Equity Master or in the stock market, it is that there is something called as good stock and there is something called as good investment. And it is not necessary that a good stock will always be a good investment. A good stock can be an average investment or a bad investment if the valuation of the good stock is pretty high and it is fairly valued, or if it is overvalued. Whereas stock which is of slightly inferior quality than a good stock can end up giving good returns if the valuation difference between the two is huge. So if good quality businesses are available at a premium to their intrinsic values or are fairly valued, then there is a possibility that they may not give the best returns from a long term perspective. The best returns could be given by companies where the investors are taking a pretty subdued view of the stock, and it is being punished unnecessarily, and its valuations are so down that even a slight improvement in business fundamentals will help the company uh, move its share price up in a significant manner. So this has been the biggest learning for me in my 15-year career in the stock market, is that it is not necessary that you would do well in the market by investing in good stocks. You need good investments and not good stocks. By good investments, I mean that company may be of a slightly average quality than the companies in Group 2, but if they are valued significantly lower than companies in Group 2, then these stocks could end up outperforming over the long run. So that's one of the key lessons that you also need to keep in mind when you invest in stocks. Uh, it's not necessary that you will make market beating returns from good stocks, good quality stocks. Average quality stocks can also give you great returns if you buy them at pretty low valuations. Now, of course, you would be interested in knowing the names of the companies under these three groups, and the companies that I have chosen for my studies. They are there on your screens right now. Under Group 1, I had chosen HIL Limited, Technograph Industries, and Navin Florin. Group 2, I had chosen Asian Paints, Exide Industries, and Infosys Limited. And Group 3 consisted of Jet Airways, MTNL, and Arcon. Now, of course, there would be a lot of questions going through your minds as to why did I select these companies? Have I cherry picked those companies, or have I deliberately chosen a more favorable time period, or or why not take a 2-year returns or a 4-year returns instead of taking a 3-year returns? And these are all valid questions in my opinion, but having said that, you have to look at the underlying logic, and the underlying logic I think is so strong that if you take any other sets of companies, if you take any other time period, or if you take a different time horizon, the result is going to be the same. Let me put it this way: if over a very large number of investments that you make, you will realize that it is not the very good quality companies that are trading at expensive valuations that will give you the best returns. It will always be companies which are of average quality, may not be as good as the best quality businesses, but if the valuations are so attractive, it always pays to invest in these companies than buy those high quality companies at expensive valuations. So do this exercise over any different time period, or choose a different universe of stocks. I think the results that you will get more or less is going to be along similar lines if you do it over a large number of trades. Now, I have spoken about group 1 and group 2. Why have I not spoken about group 3? Well, the thing is that value investors don't call group 3 stocks as investments. They call it speculative bets. They call it speculative bets because they don't have a sound financial history. We saw the numbers of group 3 companies, between FY7 and FY13, and the track record was pretty poor, high leverage, making losses. So such companies are, best suited for speculation and not investment. For investments, you should invest in either companies from companies which are similar to companies in group 2 or group 1. Group 3 companies are best left for speculation, and you should not invest a lot of money in stocks of group 3. So this is what I wanted to show with my case study today, that the kind of stocks that could make you the best returns from a long term perspective are not the stocks that are good quality and are trading at inexpensive valuations, but average quality stock trading at very attractive valuations can end up doing much better and can help you earn market beating returns over the long term. So that's the lesson I wanted to share with you today. Now, before I leave, if you are liking our videos, please show your appreciation by way of pressing on the like button. uh, your appreciation means a great deal to us. It makes us really happy. And of course, if you need to say anything more, there's always the comment section. So that's all from my side today.